This is Shelly Kraft coming to you live on SNN Live. We're at the 5th annual meeting of the International Stock Exchange Executives Emeriti, that's ISEEE, here in Orlando, Florida. I have David Weild of Capital Markets Advisory Partners. And David, welcome to SNN Live.
Well, thank you, Shelly. It's nice to be here.
I want to focus with you right now on something that's been on my mind. And not only on my mind, my subscribers' minds, all the companies that I've interviewed, when it comes to what's going on in Reg A and Reg D. And I know there's changes, there's bills, there's things about to be signed into law. There's a lot of confusion as well.
Right.
Tell me, what is it about Reg A and Reg D that's changing?
Okay, well, first of all, let's define the two. I'll start with Reg D because that's the private placement exemption that the vast majority of venture capitalists rely on when they do when they raise money. It is historically you have been prohibited from doing what they call a general solicitation, and so when you actually had to distribute the private placement memorandums, people would keep track of who they sent them to, send out numbered documents, and the idea was essentially to make sure that you weren't accused of tainting the offering by soliciting. Just a solicitation of a non-accredited investor. Unaccredited investor could taint the offering and give everybody a rescission right. And so, of course, nobody wanted to do that, and it made the marketing process very encumbered, very constipated. And so I think that the SEC, actually this came out of one of the recommendations that we made in a wake-up call for America, which is a study that we published, and they just finally, I think, decided and agreed with our point of view, which is that, why are we protecting members of protected classes from broad solicitations? And as long as you control who actually purchases the stock, that the transaction shouldn't be tainted. Well, the beauty of this is that entrepreneurs and their investment banks will now be able to run a broader marketing effort, so it should help get capital into private companies' coffers more easily. It should bring down the cost. The other change, and this is in H.R. 3606, which is the bill. And by the way, we think that it was going back to the House because there were some amendments, an amendment that was tacked on by the Senate when it passed the Senate this past week. But the President has already said, to both houses in Congress, get me a bill and I will sign it into law. So we're very confident that this is going to end up being the new rule. We have also, the number of shareholders is being increased, and it's going to go from 500 to 1,000, I believe, before you have to register with the SEC. And I think that there's also some exemptions. You should check this from the bill. You can find it if you Google H.R. 3606, the Jobs Act. You'll find the bill online. But I believe that it actually it pulls from the count certain employees and other classes. So as a consequence, it's going to allow private companies, if they want to stay private longer, and possibly to avail themselves of some of the secondary liquidity platforms that are being created in the private markets, such as Second Market Shares Post, Greencrest, Knight Securities is working in that direction, LiquidNet, others. And so I would expect that you're going to see quite a bit of activity in the private markets, which of course is critical to job formation. Regulation.
So are they going to call this new bill the David Weild bill?
No.
I know you had a lot to do with it.
I was talking to Harry Kellogg, and who's the vice chairman of Silicon Valley Bank, and a terrific guy. And Silicon Valley Bank just did yeoman's work in terms of getting entrepreneurs to write to Congress, sign petitions, and so I wanted to thank Harry for their work. But interestingly, he said to me, I hope you get credit for this. And I got to tell you, I am so tickled. I really don't care. It takes a village to get these things to work. I think we wrote some of the cornerstone arguments, but I mean, literally, people like Kate Mitchell, who chaired the National Venture Capital Association, the NASDAQ stock market's been helpful. The New York Stock Exchange has been terrifically helpful. Reagan Anderson is one of their...
Survival, David. It's survival. I mean, let me tell you. Look what's happened in the markets. It's not, it's so obvious. You don't have to be an expert. You don't have to be a witness. You just have to know that liquidity's disappeared, IPOs have gone lower, it's harder and harder to raise money, there's no market making going on, there's been more BD withdrawals than creators, you know what I mean?
Right, and you're exactly right, and we know we got to fix it, but you know what's motivating people is they want to do something that really is going to help the country and help the next generation. That the Intel, when it went public, okay, in 1971, it was an $8 million IPO. It missed delivery on its first new product out of the box, and the stock traded to it had then a float down lower than $4 million. And so that stock would have never been dug out of the ditch if there wasn't a real economic incentive for salespeople to get back on the phone. I mean, there are so many of these cases. I mean, I do the case study of Microsoft when it went public in 1986, and it was a little bit smaller than a $60 million IPO, but there were 116 underwriters in that deal, Shelley.
A micro-cap deal.
And that's right, micro-cap IPO, and it had over 80% of those underwriters today are no longer in business. And if you look at the LinkedIn deal that was done in this past year, 2011, there were 5 underwriters. I mean, think about that. You go, and the deal was 6 times larger. So you go from 116 underwriters in 1986 to 5, all the biggest names on Wall Street. And then you don't have to look much further to kind of understand that there's some serious pathology there.
And also, by the way, let's not mistake the missing investors, whereas the institutions took most of that underwriting down, correct?
Well, that's exactly right, and but the ability, if you think about it, the ability to maintain that standing infrastructure, all the on-ramps, which are the salespeople, to make the phone calls, if they can't be in the business day in and day out, broking stocks, selling stocks, right, then their ability even to position and sell a story and maintain a story in a client's account is compromised. And that's another thing. We took 100,000 retail brokers in the United States that used to be one of the greatest marketing machines that has ever existed, and we've turned them into asset gatherers and allocators, and it's not clear that investors are any better off. In fact, I think they're worse off, because what we've done is we've depressed the growth rate of the U.S. economy, and obviously investment returns are highly correlated to growth rates. So you've got guys that are out of the business of selling and marketing stocks, right? You can't support them any longer. And at the same time, investors are getting charged as much as they ever were. It's kind of on the commission side. There's a major European money manager, and I was sitting in sort of the Cadillac, if you will, or the Rolls Royce of pension fund advisors in Europe is a firm called Hermes. And I was talking in London to this pension fund manager, and he said that the whole commission thing is a bit of a farce. We haven't saved anybody any money. It's whack-a-mole. We just moved the commissions around, but we're still, in our analysis, this is a major pension fund of the mind that we're paying as much money as we ever did through these change structures. So I love it that when you come to the point that conclusion that we've done no good in the last 15 years, and we've done lots of harm, but it was all well-intended. Okay, so that's a little bit of where we come out. I want to get back to Reg A. You asked me the question about Regulation A.
By the way, I just want to say, with the analysis you just gave on Reg D, amen. Okay, let's go to Reg A now.
Okay, Reg A is another exemption from registration with the Securities and Exchange Commission, and it was very seldomly used, and partly because you are required to go through blue sky state-by-state registration. And so what they've done is they've taken the ceiling on it from $5 million to $50 million. What's different about the Reg A exemption from registration is it's really a hybrid between public and private markets. You can actually market transactions to unaccredited public investors, right? So you can broaden the market. Again, there's no exemption from state registration yet, but the bill actually asks the SEC, or requires the SEC, to study whether or not there should be an exemption or some kind of central review process, if you will.
What about registration with S&P?
Registration with S&P, I don't think...
Doesn't that give you blue sky in 32 states?
It's a great question. I don't know the answer to that. maybe you have a loophole, a way to.
You heard it here first, folks.
I have to take a look at that, Shelly. But what it allows you to do now is actually market more broadly, and so it's another tool in the toolkit of entrepreneurs, if you will, to raise capital. And I think that it will. I think particularly for companies that want to raise capital locally within a state, file with a handful of states to kind of broadly market to retail and institutional investors. I call it an enhanced Reg A exemption because it does require the company to file to produce audits. There are some disclosure requirements around it that don't necessarily occur in a Reg D exemption, but of course I think that's only reasonable considering that you're entitled then to market to unaccredited investors.
Ladies and gentlemen, an expert in the business, let me tell you. David Weild of Capital Markets Advisory Partners, and I need your website because I know you're going to get some traffic.
CMApartners.com.
CMApartners.com. We are at the 5th annual meeting of the International Stock Exchange Executives Emeriti in Orlando, Florida. And thank you for coming on to SNN Live. It's always great to see you.
Terrific seeing you, Shelly. Thank you very much. Yeah.